are here to talk about crypto's challenges and the path forward. So far, I think probably at most of this conference, you've heard a lot of bullish stuff. We're here to talk about what might go wrong. And the interesting thing about crypto is that not only is there a lot that can go wrong, a lot does go wrong all the time, and yet somehow we happen to make it anyway. That seems to be kind of the story of crypto historically, is that everything that can go wrong eventually does go wrong, and then somehow we still survive. So let's start by talking about stablecoins. So you spend a lot of time in DC. I spend a lot of time reading about DC. I don't spend as much time there. And there's a lot of kerfuffle right now about the stablecoin regulation. What's your sense of what's going on there and what might go wrong?
Yeah, first off, what an amazing venue to talk.
Yeah, also, this is absolutely beautiful.
Congratulations to the Avalanche team for having us. It's a really, really interesting time right now. We've been under threat, attack. Gary Gensler really wanted to put an end to us, but you just can't kill this technology, right? It just won't go away. And yesterday, something pretty big happened, but actually wasn't that big, because the Senate voted on something called cloture. So they said, hey, we're going to stop arguing over this bill, and we're going to move forward with it. And so we don't even, this isn't like a vote to have the law go into effect and send it to the president. This is a first procedural step. But I think it was very interesting to see a number of Democrats, like 16 of them, I think, came over and said, wait a second, we're going to support this thing. But what are some of the storm clouds on the horizon? Guys, this should be the easiest piece of legislation in the history of mankind. It's the greatest thing that could have ever happened to the greenback. Why? It's our greatest export, right? And if you have stablecoin legislation, you'll regulate it, and what it'll do, it'll extend the dollar as a reserve currency for decades to come. It'll force people to buy treasuries. It'll probably be the issuers will probably be the #1 buyer of treasuries. We like that in the US. We like people when they buy our debt. It'll keep rates nice and low. But gosh, the amount of struggle that we went through just to get this cloture vote tells me that as we start looking forward into market structure, which is much more complex, it's going to be tough to get. What's your take, Haseeb?
Yeah, I mean, so it was very surprising because last year, you might remember, we had the first bipartisan vote on crypto, and that was like, oh shit, things have changed, right? There's now a real vibe shift that happened before the election, that crypto is now bipartisan in the US. And then, I think it was, last week or 2 weeks ago, that you had this big walkout.
Yeah, 9 of them.
Yeah, and it was this big dramatic thing that like, oh, wait, hold on. Before we end up voting on anything on crypto, the Trump family has to not divest per se, but like have some law passed such that the Trump family can't engage in crypto.
Well, no, they actually said, well, we have a national security problem with this thing, right? That was the first thing they said.
Okay.
And so we reached out to them. I chair the Blockchain Association National Security Committee, and I'm a Marine. And I'm like, hey, guys, let's talk. Ruben Gallego is one of the voters. He's a Marine. I'm like, dude, like, do you have a problem? Crickets. But to your point, it's because they have Trump derangement syndrome, and they just couldn't get over the fact that this guy has a stable coin.
I mean, look, to be clear, I understand where they're coming from. It is questionable the way in which the Trump family, affiliates itself with foreign actors, whatever, blah, 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 blah. But it looked like for a second that was going to derail the stablecoin bill. And the stablecoin bill was supposed to be the easy one, right? The market structure bill, which actually defines how crypto gets regulated, what's security, what's not, that one is the hard one. And we were like, okay, easy little putt, and then we'll go for the more difficult one. Now it looks like maybe both of them will be difficult. Now, the House, we've yet to see what's going on there. But the Senate, they passed cloture. Passing cloture means that now they can actually debate it on the floor. But my guess is that, okay, you had 16 Democrats say, okay, cool, let's bring this to the floor. That probably means it's going to pass in the Senate. Yeah?
I think so. Yeah.
Okay.
I think.
What do you handicap the odds at?
I think it's going to definitely pass the Senate. I think we're on a glide path to getting a law in place. I think it's going to happen.
Okay.
Beyond
what do you put the odds at, though? What do you put the odds at? Is that 90? Is it 70? You think 90?
I do.
Okay. All right.
I mean, look, America, we're here in London, right? What does Winston Churchill say? That
America.
Democracy is the worst form of government, except every other government. I'm murdering that.
Oh, okay. I thought you were saying Americans will do the right thing once they've tried everything else.
Same thing, right?
Okay,
so we'll get there. Because it's the right thing to do, and it's so important for our country, right? And it's important for any country, I think, to adapt. And even, I met with Rachel Reeves the other day, and she's thinking about a stable coin. Now, it's really interesting. In this legislation, though, you're not allowed to pay interest. kind of interesting and weird in a way.
Well, that's the Senate bill, right? The House bill.
Yeah, my sense is that it's going to come out without having the ability to pay interest.
Yeah, and so why is that? Why is that?
Well, I think there's some special interest at stake. But it's kind of weird, isn't it? Because, like, if you step back and you're like, what's the risk? What's the difference between a money market fund, like our buddy Rob Leshner has, where you buy a bunch of treasuries and it's a security and you pay interest, and a stablecoin, where you buy a bunch of treasuries and you don't pay interest? Like, is there a risk difference here? And why are we making a big deal of it? So I think my personal take is that the non-interest-bearing stablecoin is actually going to be bullish for crypto. And I'll tell you why.
Okay.
All right?
Why?
Because if you don't have interest, you want interest. Where are you going to get it? You're going to go into DeFi, right? Or you're going to seek to swap it into tokens like AVAX, or I'm sorry, they say AVAX. So I do think it's going to be bullish for alts. I think it's going to be bullish for DeFi as well.
Okay. I mean, the most basic thing in my mind is that the reason why these things are not going to be paying yield is because the banks are terrified. And the Fed is probably terrified, is that if this thing starts draining deposits out of the commercial banking sector into the stablecoin complex, then banks are potentially fucked.
That is exactly the concern.
Yeah.
But why aren't they freaking out about money market funds?
Money market funds are not tradable 24/7.
Exactly.
Yeah, exactly.
Yeah. And I think this is why tokenization is so exciting. I'll just jump into it.
Yeah.
Look at you know what the meme coin market cap was last year?
I don't.
About $140 billion, right?
Is that really market cap, though? I mean,
but think
is
about
that analogous to market cap?
You know,
okay.
it's a metric, right? It's not a perfect
sure,
metric.
fine,
We'll talk about metrics later.
Yeah.
But you have a completely unimpeded by regulation, pure access to that 24/7 borderless demand, right? And that's what I think we're going to hopefully get with stablecoins. Very, very exciting. That's the secret power of tokens, right?
I agree with that. Okay, well, so one other part of this narrative of why stablecoins are scary and why it really is, once upon a time, it was beyond the pale to imagine that stablecoins were going to be allowed. The conversation, like if you remember 5 years ago, was when are we going to ban stablecoins, right? Because obviously stablecoins allow you to evade sanctions. They allow you to buy drugs. They allow you to do all sorts of terrible bad guy type of stuff. Now it's a different world. But we still had, not that long ago, the biggest hack in crypto history, which was the Bybit hack, which was on the order of over $1 billion that was hacked out of an on-chain wallet. And that hack was perpetrated by North Korea. And so you spend a lot of your time in the Hill looking at how national security intersects with what's going on in crypto. How do you think about this situation?
Yeah, again, I think stablecoins are the greatest thing that could have ever happened to national security. I mean, could you imagine today, Haseeb, if stablecoins were the norm, right? That everyone used stablecoins as a norm. And then I called you. I'm like, dude, I've got this great venture investment. I want you to join the cap table. We're going to lead. But we're going to take money. We're going to write it on a paper, and we're going to give it to each other. No one's going to know about it. Do you know the response that we would get? It would be insane. And crypto people don't like talking about this, but the fact is, you can go through due process, and you can freeze and seize. And so if that token goes off to North Korea, you can go through due process and seize those treasuries where the value is. Now, there's one real big issue with this, and it's latency, right? The North Koreans are really fast, and they're very good. We're actually better. In fact, they stole $2.4 billion in the last 2 years. This is Lazarus Group, state-sponsored. And the sad thing is that in the past, we had these young startups. It was brutal to raise money, right? They raise money, they give it all to the lawyers, and then they get hacked, and then the government would say, "Shame on you! I'm going to punish you because They would blame the victim, right? I think personally, and we published a paper with Christian Carlo. There's only one way to address this latency, and it's kind of appropriate to talk about it here in the UK. But did you know that we won the Revolutionary War in the United States not because of the way our armies maneuvered at Yorktown, but it was because our privateers ravaged the British economy, ravaged it. War of 1812 came around. James Madison authorized 500 privateers, and that stopped the war. It's so important to the United States. It's actually enshrined in our Constitution in Article 1. So I think the only way that we can address this threat is to no longer play defense, but to go on offense, and to commission private citizens to have what's called a letter of marque to go on offense. And that's the only solution that I see. I would welcome other policy responses.
Okay, you got to flesh this out. What exactly are you imagining here? How does one go on offense against North Korea?
So if you read the Constitution, it's enshrined. It's part of our culture. It's been in hiatus for 200 years. But the Congress has the ability to authorize private citizens and enterprises to go violate the law, in this case it would be OFAC, to go on offense and hack our adversaries. The Constitution says by land or sea. I think we can adapt it to.
Okay, so by TCP/IP.
100%.
Okay.
And like, there's to me, you have to go on offense. Otherwise, it's funny. After we published this paper, phone started ringing. Hey, I'm so and so of special operations. Hey, we want to do this. So we just need the authorization. Our entrepreneurs, our people are better than the North Koreans, and we need to go on offense. My 2 cents.
Okay.
What do you think?
I have spent zero time thinking about this, but I'm starting right now.
All right.
I guess one question is, okay, practically speaking, let's say that we authorize that now you can be a privateer and be basically a vigilante and go fuck up North Korea.
Pirate.
On-chain or whatever, like using hacking them. What if you end up hitting somebody else?
Yeah, so in history, what they actually had was stakes. So you'd actually post a bond, there'd be courts, and that would be adjudicated. If you made a mistake and you did the wrong thing, your stake would be slashed. It's very similar, isn't it?
Okay. And is there some kind of bounty or prize or what's?
Yeah, like prize courts would adjudicate who gets what. You give some back to the victim. It's better than zero.
Okay.
So we go to the government. Maybe we can use it to fund the Bitcoin reserve. You never know.
Oh, wow.
Oh, by the way, the greatest thing about this is it's tax-free. Taxpayers don't have to pay a thing, right? We can do it today where you can hire contract people, but taxpayers pay.
Yeah. So basically we enlist our own citizens as mercenaries to go out and be bounty
Or
hunters.
foreigners. John Paul Jones was not an American.
Okay, fair enough.
Yeah,
Fair enough.
yeah.
Wow.
So let me ask you a question. If
Yeah.
it's okay to pivot. We took care of the pirates.
Yeah, I think we nailed that. I think
right.
everyone understands what we mean.
MicroStrategy.
MicroStrategy.
Everyone seems to be pouring into this trade.
Yes. We're seeing the microstrategization of everything now.
Sorry, I should say strategy.
Okay.
Can you explain what it is and why it's so exciting and why people are pouring into it and what could possibly go wrong?
Yeah, actually, let me do this real quick. Let's just see a show of hands. How many people feel like they understand what MicroStrategy fundamentally is? Raise your hand high. Okay, so I see less than half people understand what MicroStrategy is. So here's what MicroStrategy is, okay? MicroStrategy is a company that was once doing something else, totally unrelated to crypto. And one day they woke up and said, you know what, this business is stupid. We should just speculate on crypto. And so what they did was they took that company, they issued a bunch of debt, so they raised money in the debt markets, and then used it to buy Bitcoin. And they did that, and Bitcoin went up. And they said, wow, that's great. Let's do that again. And then they raised more debt, and then they used it to buy more Bitcoin and said, this seems to be working. And they just kept doing it over and over again. And now, the weird thing about MicroStrategy is that not only is it a giant pot of Bitcoin with a tiny little company on the side, but the whole value of the company is worth more than all the Bitcoin in it, right? It trades at a premium to the Bitcoin. Now, it hasn't always traded at a premium. Sometimes it trades at a discount, but most of the time it trades at a premium. And the weird thing about this is that by the nature of the corporate debt markets, it's actually a way better way to get leverage on buying Bitcoin than going on Binance and taking a levered long on Bitcoin. So it's kind of the best debt you could possibly get in terms of the terms that you have to pay back this debt. So as a result, there's a lot of people now saying, oh, wow, they have billions of dollars of Bitcoin that they're holding on the MicroStrategy balance sheet, and they're trading at a surplus or at a premium to the underlying Bitcoin. I should do that too. And so now you have a bunch of MicroStrategy copycats that are doing the same thing with Bitcoin, but you're also getting people doing it with other assets, right? So there's people doing this now with Solana. There's people who've elected to say, I will do this with XRP. I will do this with Doge. Somebody's saying they're going to do it with Trump token. And so I suspect that you will see probably before long people doing this with almost every asset. I heard the other day that somebody was saying there's a MicroStrategy for copper now. I don't know.
I missed that one.
I don't know that that's going to quite get the same speculative premium that you're going to get with Bitcoin. But it does feel like there's a deep arbitrage going on here about the nature of corporate debt. I'm obviously not a corporate debt guy. I'm a VC, so I don't spend my time in that world. But it is simply true that basically robust corporate debt is just treated differently for a lot of regulatory purposes, that certain people can buy it, that other assets you can't buy. And as a result, it's just like a different nature of capital that you have access to when you're able to issue corporate debt. And so that arbitrage seems like it's going to continue for quite a while. I don't know. What's your take?
Something seems broken, right? It just doesn't seem. I mean, we saw this, the Widowmaker trade in the last cycle with the Grayscale trade, kind of similar, right? And that was all about making it easier for people to access the asset class than having to worry about all the other custody and other issues around it.
Right. The problem with the Grayscale Trust was that there were no redemptions.
That's
right.
right.
So the money comes in, doesn't come out.
And here it's a little bit different.
Yeah. Well, it's still true the money doesn't come out.
Unless they sell it. But the point is that retail continues to want a couple of things. We saw this with the ETF. They want it to be very easy operationally to buy something. And they want a known like regulatory structure that they're comfortable with. So here they're just buying another security, just like the ETF, another security. I don't know how this ends. I think we're seeing a ton of people pouring into it.
Yeah.
It's kind of interesting that I haven't seen AVAX yet. I'm sure that's coming, and maybe someone in the audience is working on it.
Wink, anybody?
We've heard about a lot of ETH. We'll probably see some of that as well. Typically with these things, everybody pours in. There's a consolidation. There's probably going to be one, maybe per asset, maybe per region. I don't know. Surely at some point, when prices crash, it'll wash out a few folks. But I don't know.
Well, that's the thing, is that you can actually, with this structure, you can survive an asset crash, right? As long as it eventually goes back up later, like you're not getting margin called the way you are on Binance. So the interesting thing about this trade, I would have thought that MicroStrategy, because MicroStrategy started like in what, 2020 or 2019 when MicroStrategy first began. So it's been 5 years now that they've been doing this. And I sort of thought that once we get an ETF, it's game over, right? MicroStrategy, why would it ever trade at a premium? Because now, if you want to buy something in your 401k, you can just go buy the BlackRock ETF, right? Easy. But it's still happening, and it's getting even bigger, which is weird.
Yeah, and there's another issue. As we go down the tail, I would argue that derivatives markets in the United States are completely broken, and they have been broken for a very long time. This is one thing I'm actually really excited about. And what you've seen previously is that you needed to have a future before you had the ETF. There actually are some futures that are listed that you wouldn't maybe know about. An AVAX future is already listed on crypto.com, but they're not offering leverage, and there's a couple other places where they're offering it. But I think one of the reasons why these products may be appealing in the future is because they're very easy for retail to access, and they don't have access to that derivatives market. I do think Brian Quintenz is going to fix that really quick. I think we're going to see perps coming onshore. I think we're going to see listed futures coming onshore. And that will maybe help restore some of the balance, because today, we trade and we would love to hedge. We can't even hedge. Like, all you really have in liquidity is like Bitcoin and ETH if you're a U.S. person. So I think that's maybe part of the breakdown as well.
I will say, I love that we're in London and we're saying onshore. As though on the American shore.
Offshore. Offshore, that's my bad.
Offshore from London.
Sorry.
No, and you also bring up the Revolutionary War, which I think it might be a little early to...
No, I'm messing this all up, aren't I?
I could see a lot of people really, blood in their face leaving. Okay, so the other thing that I think is interesting to talk about when we talk about, some of the challenges that crypto is facing, there's this conversation going on Twitter right now about REV. Okay, now this is a deep cut. I don't know. How many people have heard of REV? Okay, way less people know what MicroStrategy is. Okay, so REV is this term. It's a relatively new term. So it's a kind of a twist on MEV. MEV stands for minor extractable value, which is basically if you're creating a block, how can you kind of fuck around to make some money from what people are doing in that block? And REV is basically a more inclusive measure of both the MEV, the fees paid to a blockchain, and the tips that are paid when you're, basically paying the miner for some MEV bundle. So it's basically all of the value that people are paying into a blockchain. And this term has gotten popularized because Solana right now is crushing it on REV. They're making a shitload of REV on both fees, but fees are actually a minority of what's happening. It's mostly tips. Mostly MEV tips, which basically means that someone wants to trade a meme coin and they're paying a very high price to snipe this meme coin as fast as they can. And there's a big debate going on right now about, is REV the right way to measure the value of a blockchain? And ultimately, is a blockchain like a company that has revenues and earnings, or is it some other thing? Is it more like money or like an economy or some other thing entirely, and focusing entirely on this measure of revenues or fees is kind of missing the forest for the trees? What's your take on this question? I
really commend Blockworks. I think they came up with this concept. Yeah. How do you try to value blockchains. And to your point, Haseeb, like they're not companies. DCF modeling probably isn't the best thing, and they come in different shapes and sizes. Introducing this metric, I think, is an important metric, but obviously, nothing perfectly trades on fundamentals all the time, and I think it's wonderful to have a standardized metric to be able to evaluate blockchain to blockchain a certain thing, right? I remember when I was at Citigroup, I sat down with our chairman one time, and he's just like, Chris, only thing I care about is ROE. And I'm like, okay, why? ROE, ROE, ROE. Because it's the only thing that I can compare my company to, which is a bank, to any other company out there, is a standard way to measure value. Very, very important. So look, I think it's a great metric. What we also would like to see is just more standardization of metrics. We've been working on an initiative on standardizing interest rates and staking rates. Why? Because fixed versus floating swaps are a $500 trillion industry, and you can't do that without standardized rates. And these are the little initiatives of standardized metrics that you can help bring to really mature and institutionalize our ecosystem. So look, is it perfect? No, but and the thing about crypto, right? There's that we have liquid strategy. There are metrics everywhere. It's not always easy to distill them and to really identify them, but like I think it's a great metric, one of many.
Well, I mean, to your boss's point, like okay, ROE, ROE, ROE. Saying that you want to standardize a metric assumes what you're setting out to prove, which is that you should be trying to measure the same thing for all these things which are supposed to be in the same reference class. And what's very clear, for example, look at the REV on Bitcoin. It's basically zero. And yet Bitcoin is obviously the most valuable thing that we have in our industry. Bitcoin's not trying to be what Solana's trying to be.
That's right.
I think REV is a good metric if what you're trying to measure involves a very high volatility trading venue. That has relatively immature MEV infrastructure. That is going to produce a lot of REV. Because you have high volatility assets and very, very low time discounting, where it's like, I want to trade this thing right the fuck now, and I don't want to wait.
How do you think about something like Metcalfe's law in the context of valuations of blockchains?
So Metcalfe's law, you want to define what Metcalfe's law is?
Go ahead.
So Metcalfe's law is a measure of the value of a network. And it was postulated in defining what the value of the internet is back at the time when the internet didn't have standardized metrics. And the idea of Metcalfe's law is that it's proportional to the square of the number of members of a network, Because each person network is connected to every other person, and so that's a square number of connections. And it's, again, one of these things that sounds really good. Does it actually predict prices of anything? Not really, but it gives you the false consolation of having a number that you can look at and kind of point to. Look, I think if you're measuring banks and you line up a bunch of banks next to each other and you say, okay, how do you value each of these banks? ROE is probably a good metric, But if you're taking a bank and putting it next to a tech startup, probably trying to contort what a tech startup is doing into ROE is only going to confuse you, And so I think if you're looking at what Avalanche is doing, what Avalanche is doing is really quite different than what Ethereum is doing, which is quite different than what Bitcoin is doing, which is also, I'd say, quite different from what Solana is doing, Solana is one giganto database that is highly contested for basically meme coin trading. And the way in which you're going to monetize and generate fees and become valuable is really different on Solana than it is on many of these other chains. And of course, if you're looking at an exchange or a DEX, that token is doing something very different than what any of these L1s are doing. So I think REV is, in a way, Blockworks developed this metric to justify why Solana is so valuable. And I think they're right to do it because Solana is really valuable. And it's valuable for a different reason than why Ethereum is valuable, Back in the day, the way that everybody looked at the value of L1 chains is looking at TVL. And TVL, of course, total value locked, which is basically the AUM of a chain. And the AUM of a chain, we quickly realized, is actually not a perfect metric, but it was at one point. At one point, TVL actually was almost one-for-one predictive of the prices of different chains. And the reason for that was that it was very hard to get TVL. TVL was very scarce. And TVL followed the actual economic activity happening on a chain. But those two things have decoupled as people have learned, I can just buy TVL. I can just rent TVL. I can go do a TVL deal, The concept of TVL deal did not exist 3 years ago. Now they're commonplace, You can just go and find these, KOL groups or these whale groups, and they'll quote you a rate of like, hey, we'll give you TVL for this much APY, and that allows you to basically game this metric in such a way that it no longer represents reality. REV is a difficult metric to game, but obviously not an impossible one.
Are you in the KOL group?
It's like Fight Club. You're not allowed to tell whether you're in the KOL.
So we have a few minutes left.
Yeah.
There's been a lot of noise around putting equities on chain. And it feels like, from my vantage point, this is going to be a reality. Do you have a view on that? Timing, impact? How do you think about that? I mean, this seems like the next big thing in my mind.
Yeah, I mean, it's one of these things that I've been told is the next big thing for about 10 years.
Yeah.
So I'm a little bit like, okay, bring the receipts, right? If you're going to tell me that it's the next big thing, it's a little bit boy who cried wolf, right? Here's where my skepticism comes from, and now you tell me why I'm wrong. I think a big part of the reason why on-chain equities have not worked historically, because they've been tried many, many times. Yep. The reason why they've not worked historically is that the people who are on-chain are not here to do the safe part of their portfolio. They're here to do the batshit crazy part of their portfolio. And if you're doing the safe stuff, right, it's like the reason why, the on-chain treasuries are great and they're growing, but they're still tiny. Right, in relative terms, compared to the stablecoin complex, it's 2% of stablecoins are on-chain treasuries, right? They've not really grown in proportion to the way that they would if you look at the relative proportions in the real economy, right? And the reason why, very simple, is that when you're on-chain, you're here to gamble. You're here to do the crazy stuff. You're here to lever up 5 times and do 40% APY stuff. You're not here to do the safe stuff. So okay, maybe if you're going to bring on Tesla. Or MicroStrategy, or you're going to bring on chain, GameStop. Okay, maybe there's demand for that. But if you're coming on board and saying, hey, don't you want your nice dividends from your Apple stock? It's like, not really. That's not what people are here for. Now, that will someday change. And slowly we're seeing the safer portion of people's portfolios coming on chain. But it's not even the safer part of their portfolios. It's a different set of people. Yes. Who are coming on chain, and those people are doing safe stuff, and they're coming in through the new banks of the world and through these more traditional players onboarding users on chain and then bringing them other financial assets. But the crypto natives, they're not buying Apple stock on chain.
I totally agree with the demand side and the challenges of legacy demand based on those crypto natives that are punting right for the fences.
Yeah.
I think as time goes on, though, we have to address some realities, and that's the fact that public markets are broken. I mean, they're really broken. You know how much money we raised in IPOs last year? $30 billion, right? Remember I talked about the 140 billion meme coin market cap? It's apples to oranges, but it kind of gives you a flavor, right? 81% of companies in the United States with over $100 million in revenue are private. What does that mean? It means like the people that would love to have access to the most exciting, innovative companies, they can't. They're on the sidelines. They want that access much earlier. And so the one thing that I think about is that the superpower of tokenization is that borderless, 24/7 global demand, and we see that pent-up aggression. Is there a way for companies to directly list, saving themselves 5 to 7% of their stock by paying investment bankers, accessing that global liquidity, and having that price
You think it's not a mature public company story, it's an IPO story?
Yeah. I think it's going to accelerate a way to IPO or issue. You can actually now issue new equity on chain through a direct listing. So direct listings were 300 million last year versus 30 billion IPOs. I think in time it's going to slip, but I think we're out of time, sir.
I think we are. Okay. Well, thank you, Chris. Let's get a round of applause.
Thank you, sir. Thanks, brother. Really appreciate it.
Thanks, everyone.